Welcome back, Strongman Personal Finance. We got to cover the amazing, mind-blowing, earth-shattering earnings of Carvana Co. Carvana was a stock that I was pretty sure was going to go bankrupt. It was not looking good for this company. It looked like they were on the verge of going kaput. That was my personal opinion, and I was wrong. Therefore, I am a fraud. But if you look at the stock price over the last 5 years, we saw a massive run-up during the pandemic. Then we saw a massive crash as the company was basically almost going to go bankrupt. And now it's starting to recover. Why is that? Well, they just released their Q2 2024 earnings. We have some fantastic news. The company's second quarter net income was $48 million, so they have a profit, which is rare for this company, and a net income margin of 1.4%. That means after all expenses, their total profit margin was 1.4%, which is also an improvement for this company. Here's the really funny part. Carvana said in a separate filing that it would make an at-the-market offering worth approximately $1 billion in stock. They're issuing 35 million more shares. You're going to see a theme with Carvana. But let's go ahead and dive into the earnings first. So we see retail units, okay? They have basically two segments that they show, retail and wholesale. Retail units, this is actually very confusing when you first look at it. In 2023, they sold 312,000 units to retail. In the first 2 quarters of 2024, they sold about 192,000 units, okay? When I first saw this, I thought they had a massive drop in units. This is the worst way they could possibly present this information, okay? But they've sold approximately 191,000 units. So if we do the math, if we annualize that number, we're going to see how much they could potentially sell in the current year. So all I do is I take that number, multiply it by 2. So they could sell approximately 386,000, which is a huge improvement over 2023. They're kind of reversing the trend of that massive decline from 2022 to 2023. And as interest rates go down, remember, used cars have higher interest rates. If interest rates come back down, this company, should hopefully see increased demand. But for now, they're reversing the trend of declining retail units sold, but they're still not going to potentially be back to all-time highs, at least not yet. Total revenue, we can see revenue is about 6.5 million for the first 2 quarters. Not quite what it was in 2022, but it's definitely going to probably surpass 2023 unless they have a huge drop-off at the end. Total markets at year-end. So they basically developed all of their current infrastructure, basically, like the towers, the freaking vending machines. They've basically almost peaked out. Like they haven't added any new markets or places that they're selling cars in a couple of years, which they really can't afford to expand right now because they're barely profitable. And they basically flatlined on annual production facility capacity. Now, an interesting thing I noted is that the gross profit per unit continues to rise. They keep making more money directly from the sale of the car. Gross profit is the profit of, they buy a car, they fix it up, they sell it for a higher price. That's the gross profit, and it excludes other, company corporate level expenses, selling general administrative stuff like that. That's good because that'll result in increased future profitability. You want a higher gross profit per unit, obviously. So the trend is good. The trend is increasing. On top of that, they have a profit margin. You can see they were unprofitable 2014 all the way to 2021. Massive loss in 2022. And now they've eked back into a profit in 2023 and 2024. So that's a good thing, okay? So this investor presentation covers some other things about Carvana, okay? They buy used cars and they sell them. Amazing. And they have a nice, cool little app, and it's very convenient. And it's going to change the world. But we need to look at the financial statements. So first, we're going to start with the balance sheet of Carvana Co. and subsidiaries, condensed consolidated balance sheets. I like to always look at the current liquid assets of the business. How much cash and cash equivalents do they have on hand? Well, they've got $542 million of cash and cash equivalents. I know the text is small. I apologize. Restricted cash, $65 million. Accounts receivable, $349 million. And finance receivables held for sale. I guess they're, factoring out receivables of $758 million. So all of these are fairly liquid, and they're going to be converted to cash. So the very liquid cash that they have is roughly $1.7 billion. That's the roughly liquid cash. Now, inventory, you're going to sell inventory, but you can't really convert it to cash that quickly. You have to actually generate a sale. Beneficial interest in securitizations, hard to convert to cash quickly. Other current assets, probably prepaids, and due from related parties. These are all more difficult to convert to cash. So if you want to look at the liquidity of the business, you want to look at cash, cash equivalents, accounts receivable, and marketable securities, stuff that can be converted to cash. Why do you care about that? Because you want to see if they can pay their current debts. So their total current liabilities that are due within a year, accounts payable and accrued liabilities, these are like bills that are due very soon. Like they bought inventory on credit, and they got to pay it off. Short-term credit revolving facilities, current portion of long-term debt, and other current liabilities. Their total current liabilities are $1.1 billion. So they have the liquid cash to pay their debts within a year. So I don't see like imminent bankruptcy. Okay, that's good. Let's look at their long-term assets. So this is where the problem comes in with this company. They have property, plant, and equipment of $2.8 billion. This is like their buildings, etc. Their freaking, vending machine, their car vending machines. They mostly own most of their property, plant, and equipment. They don't lease it, which makes sense because, somebody's just going to randomly build a car vending machine and then lease it out. They own the vast majority of their buildings instead of renting them. It's a very asset-heavy, very depreciation-heavy business because they have to build buildings to house the cars and, fix up the cars, etc. $2.8 billion worth. Their long-term debt is $5.4 billion. So they still have a pretty heavy, significant amount of debt. And it's actually increased over the prior year. So this is a very long-term debt-laden business, and you want to pay attention to when this debt starts to mature. Because when this comes due, if it comes due soon, it's going to have to be paid. It's going to have to be refinanced with higher interest rates. So that's the one big red flag on the balance sheet is they have a lot of long-term debt, not really securing any long-term assets that are, they have long-term assets, but the long-term debt is way higher than the long-term assets, which is not good. Usually that indicates they probably made some bad purchases in the past. We can also see that they're increasing their common stock outstanding. This is the big one. Okay, they're issuing a ton of shares. Let's see how many shares that they issued. As of June 30th, 2024, they have 121, thousand, or I guess that's in thousands, maybe 121 million, versus 114 from 6 months before. So in the course of 6 months, they have issued 121. Let's move this over here. 054 divided by 142,389. They have issued an additional 6% shares over the last 6 months. And if you go look at the share issuance over time, you're going to notice that they give out a lot of shares because they've been unprofitable for a long period of time. And they still have that long-term debt, and they just announced they're issuing an additional 35 million shares, which is, I guess that's smart because the stock is running up. They're getting, they're getting more bang for each buck. But you as the owner are being diluted. It's a pretty significant share issuance that they just announced. Okay? Surprised the stock didn't freaking crater, but apparently they're, going to be amazing. Accumulated losses. So far in this business's entire life, it's lost $1.5 billion, almost $1.6 billion. And of course, I can hear machine guns in the background because I'm on an RV base. Okay, so let's look at the income statement. So retail sales revenue is back up pretty significantly year over year. That's a pretty good growth. The year over year change in revenue growth for the most recent quarter is 2411 divided by 1961, 23%. Pretty impressive growth, okay? Wholesale unit sales and revenue is actually down a little bit, though. Other sales and revenue are up a little. So the most material part of their business is retail vehicle sales. This is where basically all their revenue growth is coming from, all the recovery is coming from. We also see the gross profit. We know the gross profit per vehicle is increasing, which is a good thing. They have a gross profit of $715 just after selling their vehicles. They're selling general and admin expenses up very slightly, about $3 million for this quarter versus last year. Nothing crazy. And then other expense, whatever that is, there's not enough detail here, down about $4 million. So it kind of washes itself out. Total operating income is $259. Now, here's another interesting thing here. Remember we talked about that long-term debt? Look at their operating income. This is their profit from operations. The vast majority of it gets consumed by interest. Okay, you don't want like your most of your profit to be eaten up by interest, because you as the shareholder are not getting the profit. The bondholder is. They have to pay the interest of the bondholders first before you as the common stockholder get any money. And the vast majority of their operating income is being eaten up by debt. So this debt is going to be a concern, I think, going into the future. If the company can keep growing revenues and increasing gross margins, and keeping admin expenses low, and hopefully not having increasing debt, they can continue to grow their profits over time. Okay. But it seems like a lot of their market saturation has peaked, and the whole time they've been issuing an ungodly amount of shares. They're growing their share count pretty significantly. If you look at the diluted issuance, these are like convertible securities. The diluted increase is 20% increase in shares over the last year. A 20% increase. And then I guess we have to tack on 35 million here for the additional. They are giving out shares like freaking candy. Okay, it's nuts. It's nuts how many shares this company is giving off. Statement of cash flows. So, God, these are so. I wish they would put this stuff closer so you could actually see that in the numbers. But we see operating cash flow is basically the same as it was the prior year. I'm seeing if there's any major differences. There's one here. That's for vehicle inventory. So for the most recent 6 months, they spent more on vehicle inventory. Their vehicle inventory went up just a little bit by 70 million. And then last year, their vehicle inventory went down by 564 million. And it's just a timing difference of when they're buying and selling inventory. That's what the reconciliation is. It's a balance sheet reconciliation to show whether cash came in or went out for inventory, et cetera, et cetera. Let's see. Gains on loan sales. I guess there have some gains on loan sales. Let's see. Payment in kind interest expense. So I'm not sure what this is necessarily. They're probably paying or recognizing some kind of expense as they're retiring or paying off debt. Let's see what they've done with their debt. So they purchased a little bit of property, plant, and equipment, 40 million, but nothing crazy there. The vast majority of their financing cash flow is paying long-term debt. So they received 101 million of long-term debt, but they paid off 303 million. So the net payment is 202. They had a net payment of long-term debt of $202 million. And basically to cover that, they issued stock of 347 million. So they're rewarding, the bondholders are getting paid. They're getting their money back at the expense of the common shareholders. This is the risk you take as a common stockholder. Bondholders get paid first. Okay. So overall, this business is not out of the water yet. This business is not fully recovered yet. This business is not going to the moon. They're coming back from all-time lows. Signs are encouraging. They're increasing profits, but they're issuing shares at such a crazy pace that that's basically going to be used to pay off the debt holders. That I don't know, man. I feel like you as a common shareholder are going to get the shaft. Okay, let's see. What does their debt do? So we can see they got some debt due 2028 and 2030. So they have some breathing room for their long-term debt. It's not like imminently coming due, and rates will probably be lower at that time. So it's not a major pressing issue, but it's something to pay attention to in the long run. So that's my thoughts on Carvana. I guess I was wrong. I guess the stock is just going to 20,000x. We'll see what happens with it. Don't forget, if you want a personalized video, you can send me $50. I'll make whatever video you want. Pin comment below. Check out my book, Stop Being a Broke Loser. It's on Amazon, and you can pay me $75 for a one-on-one tutoring session. I am a certified public accountant. See the pin comment below. Talk to you later.